Welcome back to another market commentary video series. Today is August 28th, and we are looking back at the month that was. It really was the tale of 2 months. At the start, we experienced some volatility with the yen carry trade unwind. I won't get into the nuance of that. What I will say is no one was talking about that really for the last year, and that was what disrupted markets. But fortunately for us, it bounced back. The second half of the month was pretty darn good for several asset classes, so we're going to review the most interesting charts that we found for the month of August. Let's get into the graphs. So again, this is the 28th of August. We have a few more trading days left in the month, but this is a pretty good snapshot of what's happened thus far. So here are several asset classes in which we invest. Let's start at the top. This is REITs, and we added to REITs somewhere in here, and you can see they were the best performing asset class in the month, which was nice, followed by foreign stocks and gold. We also added to gold, so nice to see those two asset classes performing nicely. Bonds have made a bit of a comeback, and we're going to get into bonds. Bonds have arguably been the most hated asset class over the last 3 years with higher rates and higher inflation. We've long said that tracking future bond returns is actually quite easy when you look at history because future bond returns track to current yield, and current yields have been higher, and bond returns thus far in 2024 have confirmed that relationship between starting yield and future return. The S&P up a little under 2% thus far, and again, multiple flavors of bonds are up with yields down in anticipation of not only a Fed rate cut, but some of the economic data that's been coming in a little bit soft lately, which historically, when economic data slows or the economy slows, bond prices will go up and yields will go down. And rounding it out, we have emerging markets and tech, which lost a bit of momentum. You can see tech, this blue line, had a pretty steep drawdown at the start of the month and then has basically even thus far. And then Bitcoin, which has been all over the place, which is not uncommon. It seems like every other month, Bitcoin is either up 10% or down 10%. This month, Bitcoin is down about 8.5%. So all in all, a pretty good month despite the rough start to the month of August. Now, as we've been blogging about, the Fed is on the doorstep of their first rate cut for this cycle. So what we've done is tracked the average rate cuts during a cycle. So the depth of the rate cuts for any given cycle. There's been 5 cycles since 1995. And this is in basis points, which is confusing for some people, but 100 basis points equals 1%. Okay, so 50 basis points would be half of 1%. 550 basis points would be 5.5%. So there's a couple takeaways here. One, you can see some of these steeper rate cutting cycles correspond with times of stress. So this was when the tech bubble burst. This was on the doorstep of the financial crisis back in 07-08. Historically, the steeper the cuts, the more aggressive the Fed in their cutting cycle, that could or often is a signal of economic stress. So I know a lot of people want lower borrowing costs. However, you have to be careful what you wish for. Ideally, 2% of cuts, 1.5%, just a moderating of interest rates would be preferred as opposed to the steep, aggressive cutting cycles from the Fed, which again often accompany economic stress and or a recession. And right now, the Fed is projected to cut by 200 basis points or 2% over the next year and a half to 2 years. So that's consistent with 2019, not consistent with a period of economic stress. That said, these expectations, what I just alluded to, how the Fed's expected to cut by around 2% or 2.5%, that's just an expectation which can change with economic data. So certainly it pays to be flexible there, but the story is deep cuts, aggressive cuts are bad. Modest cuts would be preferred. And there's a lot going on this chart, but it basically confirms what I just said. So what we've done here is highlighted the Fed's first rate cut being 0.5% or more. So those instances are highlighted in yellow. So this would read, the Fed hasn't started cutting yet, and their first cut was 0.5%. Okay, and notice the dates here, 2001, 2002, 2007, 2008. When the Fed goes from no cuts to aggressive cuts, and I classify an aggressive cut by 0.5%, that often can signal pain. And you can see some of these ugly red numbers for the S&P right here. And it's not a surprise that, again, these instances were more emergency cuts. The Fed felt the need to accommodate aggressively, lower interest rates aggressively to stimulate the economy. That often is accompanied by stress and or a large drawdown, which you see here. So the average drawdown when the Fed goes from 0 cuts to 0.5% being their first cut, market's down about 20% on average. And then bond yields, so this is the 10-year yield, tend to go down, which those bond prices would go up. So a lot of people ask me about what's a safe haven, what assets do I want to own if and when we do get an economic pullback? The answer is investment grade bonds have been a pretty good place to be. So if you're scratching your head on why you own bonds when rates up, inflation up, the reason why you own bonds is the other side of the cycle. When inflation goes down, rates go down, economy slows, bonds historically have been a pretty good safe haven for the most risky asset in most client portfolios, which are equities. A couple weeks ago, I blogged about things to look for when we're sniffing out a recession and high yield spreads. In other words, the borrowing costs for lower quality companies often blow out. The cost to borrow money often goes higher during a period of economic stress. So that's here. So I talk about taking our cues from the market. 10-year yields are something that we watch. High yield borrowing cost or lower quality company borrowing costs are another metric in which we watch. Those costs often go higher during periods of stress. All right, if we were to sum up why now is the time for the Fed to cut rates, this chart sums it up nicely. Okay, so this is the current Fed funds rate, 5.25%. This is the Fed's preferred inflation measure, personal consumption expenditures. It's a basket of goods that consumers spend money on, and this is what the Fed likes to watch. Ideally, these two lines would be closer. Right now, the Fed funds rate is above the core personal expenditures line, which means policy is restrictive. Ideally, you'd want to see these lines be a little closer together. A mental shortcut would be when you see the blue line get above the red line, policy is restrictive, and the Fed is likely to cut if the economy is slowing, which, a lot of people say it is right now. When this line is above the blue line, that means policy is accommodative and inflation could be a problem. And that was the case coming out of the pandemic. All sorts of unintended consequences with supply chains and pent-up demand from consumers. So people say the Fed was late to hike rates here, and many people say they're late to cut rates here. But certainly policy is restrictive right now, economy slowing. It does make sense for the Fed to cut rates in September. Okay, let's go back to bonds. So in my opening comments, bonds are quote unquote back, and it's been a pretty good run for bonds, and no one's really talking about that. So over the last year, U.S. aggregate bond ETF, which is a decent proxy for the overall U.S. bond market, up about 9%. So from October 23-ish to now, the U.S. Ag Bond Index up about 9%. 1 to 3 month treasuries, which are pretty stable. You see the line here basically straight up and to the right, up about 5.36%. So this rate environment is not so good for borrowers, but pretty good for savers. And when you zoom out and look at history, rates around 5% are actually quite normal. Of course, the way we got there with higher inflation and a very aggressive Fed hiking rates on the way up was painful in a lot of fronts, but especially for bond investors. As the Fed pauses and eventually cuts, we would expect bonds to act better, and that's certainly been the case over the last 12 months. So if you're a saver and you're an investor, you have a couple tailwinds at your back. One, bonds just got through the worst 3-year period in the last 100 years, which could bode well for future returns. The second part of that is current yield is higher, and current yield tends to explain future bond returns. So higher current yield, future bond returns over the next 5 to 7 years should be around 4 to 5%. And again, bonds are starting to act more like the safe haven that they've historically been. So historically, when stocks go down and the economy slows, bonds would go up in value and pay you some income. That really wasn't the case during the zero rate environment regime coming out of the financial crisis. So now yield is back, bonds are, as a diversifier, are back, and again, future returns should be better with higher current yields. Okay, so August is surprisingly strong, but beware of September and October. So what we're trying to do is isolate monthly returns during election years since 1950. So when this blue bar is above the line, that means the corresponding month shows a positive average return. This brown triangle shows the percentage of time the market is higher for any given month. So as the title alludes to, August is historically strong during an election year, and we certainly just saw that. The last 2 days go completely off the rails. September and October tend to be seasonally weak. So this is consistent with several of the blogs and videos that I've done. It's not uncommon for markets to act squirrely before an election season, before an election happens. That's reflected here. What's also true, and the numbers back this up, is after the election, people go on with their daily lives. And you can see the market tends to be up after the election. People get worked up, a lot of headlines. There's a lot of energy that's sucked into the election vacuum. But after the election, we come to realize that our lives really haven't changed all that much. We move on, markets move on, and we're all back to. Okay, the last slide. So a couple weeks ago, I blogged about how many Americans think the market is down this year. And many Americans, and by many, I mean like 50%, believe the economy is in a recession. And a lot of people are confused by this, but I think this chart captures why people might be feeling bad and why perception doesn't reconcile with what's actually happening. This is a misery index of sorts, and it combines mortgage rates with gas prices over the past 20 years. And this dark blue line is the current level that we're at, and you can see this is elevated. So higher borrowing costs, higher mortgage rates, plus gas prices are at their highest point since really 2008, and we all know 2008 was a terrible time. And you can see the average is about 7.6. Right now, we're just under 11. So this is what people care about. This is what's right in front of them. Gas prices on their commute to work. You know, if you're trying to buy a house, I believe with higher home prices, higher borrowing costs, there's never been a more unaffordable time to buy a house. So this is why people are feeling bad. The good news is rates on the longer end of the yield curve, the 10-year yield, has started to come down over the past month. There's been some more activity in the mortgage market. So if and when rates do go down, if and when gas prices go down, you can start to see that show up perhaps in the sentiment numbers and the real estate activity numbers. But this is something to keep an eye on when you think about consumer spending and retail, given that's such a big part of the U.S. economy. It's about 70%. But certainly, this is why people aren't feeling so good despite market up and the economy humming right along. So that's it for the month of August. If you're watching this on YouTube, feel free to give us a subscribe and a like. If you have any questions about Pure Portfolio's investment process, the way we work with clients, shoot us a note at insight@pureportfolios.com. Thanks. We'll see you next month.